The stock market looks shaky right now as the TSX has fallen by more than 5% in just the past month. Investors are worried about tariffs and trade wars. It can feel like a bad time to invest in stocks. But for long term investors, downturns create some of the best buying opportunities, especially for dividend stocks. Right now, some of Canada's biggest companies are paying out dividend yields above 6%. And if you're investing in a tax free savings account, all that income is yours to keep, tax free. Today, I'm counting down 5 of the top Canadian dividend stocks yielding over 6%. These are safe blue chip stocks with market caps of at least 20 billion. These aren't high risk investments. And based on that criteria, here's a countdown of the highest yielding stocks on the TSX right now, and I'll look at how much money you need to invest to collect $1,000 in dividends per year for each one of them. In at number 5, Enbridge, yielding 6.12% right now. Enbridge is one of North America's largest energy infrastructure companies, responsible for transporting about 30% of the oil produced in North America. Its pipeline network and utility operations generate steady cash flow, making its dividend one of the most reliable in Canada. The company has routinely hit its guidance year after year, and it's one of the most stable investments you can buy and hold for the long haul. With a 6.1% dividend yield, you need to invest about $16,400 into Enbridge stock to earn $1,000 per year in dividends. The company has raised its dividend for 30 consecutive years, which means that dividend income is also likely to rise in the future. The stock makes for a solid choice for income investors, even during market downturns. Next, at number 4 is Bank of Nova Scotia, also known as Scotiabank. Its yield is just slightly higher than Enbridge's at 6.14%. Scotiabank is one of Canada's 5 big banks. It has a strong presence domestically and internationally, particularly in Latin America. The bank's steady earnings and strict financial regulations in Canada make its dividend sustainable even in uncertain times. The company made its first dividend payment all the way back in 1833. It's paid a dividend during high inflation, world wars, and all the economic turmoil you can imagine. At 6.1%, like with Enbridge, you'll also need to invest about $16,400 into Scotiabank to generate $1,000 annually in dividends. The banking sector is traditionally a fairly safe one to invest in Canada for the long term, especially when you're talking about the Big Five. And with its high yield, Scotiabank makes for a really attractive option right now. In at number 3, Brookfield Renewable Partners. It's yielding 6.5%. Renewable energy is a good long-term growth industry to invest in, and Brookfield Renewable is one of the biggest players in it. With a diversified portfolio of hydro, wind, and solar assets across the world, this company generates stable cash flow backed by long-term contracts. At 6.5%, investing $15,400 would be enough to bring in $1,000 per year in dividends for your portfolio. For investors looking to balance income with exposure to the green energy transition, Brookfield Renewable is a compelling pick. It's a good place to park your money as well, as in the past year, the stock is up 3%, and year to date, it's up around 0.5%. That can make for a stable option to buy and hold amid all this uncertainty. In at number 2 is Telus, which yields 6.9% right now. Telus is one of Canada's leading telecom providers, offering wireless, internet, and TV services nationwide. Telecom companies benefit from steady demand, making them ideal dividend investments. And while tariffs may be bad news for the economy as a whole, Telus' services are essential for Canadians, and the stock may start to rally as investors may see this as a safe haven type of stock with good stability and a terrific dividend. With the 6.9% dividend yield, you need to invest about $14,500 in a Telus stock to collect $1,000 in dividends annually. Telus has a history of growing its dividend, and as 5G and fiber optic expansion continues, its cash flow should remain strong. In at number 1 is BCE. It yields 11%. BCE is another top Canadian telecom company, and the stock has dropped significantly after it said it would be pausing its dividend increase after announcing it's pursuing a U.S. acquisition. The sell-off has sent its yield to an incredibly high rate of 11%. While high yields can sometimes signal risk, BCE's massive market share, infrastructure investments, and stable cash flow make it a rare opportunity for income investors to scoop up a fairly generous payout right now. And at 11%, you'd only need to invest $9,100 into BCE to earn $1,000 per year in dividends. If you believe in the long-term stability of Canada's telecom industry, this could be one of the best dividend plays available right now. One of the big advantages of buying dividend stocks in a TFSA is all your dividend income and capital gains are tax-free. That means every dollar you earn from these companies stays in your pocket with no tax headaches. A market decline can be stressful, but for dividend investors, it's a chance to lock in higher than normal yields on some great companies. If you're a long-term investor looking for passive income, these 5 stocks offer strong dividends and the potential for future growth. If you found this video helpful, don't forget to like and subscribe for more investing content. Let me know in the comments which dividend stocks you're buying right now.